Day 11 of 14. We are nearly there. What are we going to look at today? Hopefully from now on, keeping the videos a little bit shorter because time is of the essence. You don't want to be forcing too much into your head at this stage. You want to be calming down, looking at dry material, getting concepts into your head, looking at ethics. So today, hopefully a little bit shorter than they've been. We're going to look at M-squared, a risk-adjusted measure of performance. And it's the one we get the most questions about. Alpha, trainer ratio, Sharpe ratio, people tend to be a little bit happy with. But M-squared, the formula can look nasty. And you've got M-squared versus M-squared alpha. So as always, let's try and explain what's going on with it rather than just swallow a formula. And we'll start with the CML. We have here the market portfolio indicated on the CML, a capital market line. And we have an expected return on the market of 11% given here. So this is 11%. Risk-free rate of 2. So the intercept for the CML is 2. And the risk of the market is 12%. Now, what do we know about the CML? Well, one thing is that the slope of that CML is its Sharpe ratio. And that would allow you to calculate the return for any portfolio that sits on that CML. So let's work that out. What is the Sharpe ratio of that CML? Well, it's the expected return. We know that's 11 minus the risk-free rate, the excess return on the top, divided by the risk of 12. 9 over 12.75. So we know the equation of the CML. And we can calculate the expected return of any portfolio on that CML just with the equation of this straight line. We can say it's the intercept, the RF, the risk-free rate, plus the slope, we now know is the Sharpe of 0.75, multiplied by the risk that you take on, the risk in that portfolio. For example, let's check that works for the market portfolio. The expected return should be the risk-free rate of 2, plus the Sharpe, we just calculated as 0.75, multiplied by the risk we take on for the market portfolio of 12. That would give you 11%, which is encouraging because that's what it should be. So pretty straightforward. As I say, any point at all on that CML should conform to this. The excitement comes in when a stranger rides into town and says, well, looky here, I've just managed to get this. And it's not sitting on the CML. It is some crazy portfolio that this stranger in town is claiming will give you an expected return of, say, 15%, whilst taking on a risk of only 10%. Oof, beating the market in terms of expected return with less risk. For only 10%, you're generating 15. Well, it clearly looks better than the market, but what we want is the answer to the question, how much? How much better than the market is that portfolio? We'll call it P. Well, I'm going to use the same idea as I used with the CML. We said with the CML, we know the slope is the Sharpe, and we can calculate the return of any point on that CML using RF plus the Sharpe times the risk you take on. Why don't we do the same for this new portfolio? We can draw a capital allocation line, I'll call it. It's not the capital market line. It's not got the market portfolio, but a capital allocation line that contains that portfolio P. And just as for the CML, we know the slope is going to be the Sharpe. So let's work out the Sharpe ratio of that CAL. What are we going to get? The Sharpe of our new line will be, well, we've got a portfolio that sits on it that gives us an expected return of 15. The risk-free is 2, so we know the excess return is 13. Divided by, we took on risk of 10 to get that 15, so divided by its risk of 10, that is a Sharpe of 1.3. Now, you're probably already comparing that to the CML and saying, okay, it's higher. Well, yes, it is higher. The slope is steeper. So we know it's a preferable portfolio. But what do we need to do to get M-squared specifically? Well, the genius of M-squared is that it will take this portfolio and it will lever it. Levering it means moving along the line. Remember, leverage does not alter the Sharpe ratio. We just move up or down the line. And what we do with M-squared is move along this new capital allocation line until we have the same level of risk as the market. So this levered portfolio, let's call it PL, now has the market risk. It's got risk of 12%. The question is, what's its return? That return is M squared. How do we work it out? Well, we know the Sharpe ratio. We can work out the expected return on that levered portfolio. All we need to do is follow along with the equation for the straight line, for the CAL. It is, we know, RF. So it's 2%. Plus the Sharpe ratio, which we now know is 1.3, multiplied by the risk you've taken on. Well, if I'm on this capital allocation line, and I've taken on the market risk of 12, with a slope, a Sharpe of 1.3, that tells me that levered portfolio has a return, expected return of 17.6%. 17.6%. That is M squared. What's the point of it? Well, when we were over here, we had a different risk and a different return. So it was difficult to really just kind of tangibly say this is how much better than the market it is. But if we lever it so it has the same risk as the market, we can now say two assets, same exact risk. We've got exact difference between the market return for that level of risk and my portfolio return for that level of risk. M squared is 17.6. If you want to compare and say, okay, what was the market return? Well, the market return was 11. Deduct that, and how much further above the market we are with M squared, 6.6%, that is your M squared alpha. Now, what actually drove me to cover this today was a question we got, I think a very good question we got on the site, which was talking about M squared, but comparing it to the Sharpe ratio and talking about ranking performance. If you're looking at 2 or 3 or 4 or 5 different portfolios, you can rank them with their Sharpe ratio, or you can rank them using M squared. Well, look at what we did to get M squared. We still used the return on the market. We still used the risk-free rate. The only thing that changed was using the Sharpe ratio of the market portfolio, of the CML, to get 11%, the market return, or using the Sharpe ratio of our new CAL to get M squared. So if these are the same and they're not changing, and the only thing you change to calculate M squared is the Sharpe ratio, well, if you're looking at rankings, the rankings using the Sharpe ratio and using M squared must be the same. If the Sharpe is the only thing that's changing in here, you will get the same ranking with M squared as you would with the Sharpe ratio. Nice bit of interpretation to finish it off. But there's M squared, there's the formula, there's an interesting interpretation question. Now get back to polishing up your weak areas, debriefing that mock, practicing your ethics questions.